In this video, I will analyze a more sophisticated example of price action analysis using several techniques like negative price factor extrapolation, validation, frequency, and multiple intersection of techniques, not to mention the usual attempt to extract a narrative out of price action to validate the trade idea. As you will see in this example, sometimes the market will not display any clear directional bias, so we have to dig into the contextual understanding of highs and lows to extract the narrative behind the candlesticks and truly apprehend what's happening in the market. Before number 1, we can see price action climbing with a relatively high level of volatility in what appears to be a standing flow formation, which immediately transforms into a running flow formation. It's interesting to notice that price creates a solid low by surpassing a previous market high to confirm the action of buyers, and right after it falls down to the surroundings of the inward and outward frequency levels of that solid low. In number 1, we have the first powerful element of this analysis, which is the appearance of a hybrid bar that pierces the solid low and closes above it, showing a certain intention in its lower tail. Price immediately follows to high number 2 in an organized motion. Take a moment to notice how price switches between different types of motion like the standing flows and running flows, and how that perspective changes depending on your point of view. As I explained in the price action trading volume 1, a fractal is a pattern that repeats inside itself, and that falls exactly into the definition of fractal flow. In other words, a flow that repeats inside itself. If we take this to a more formal mathematical definition, we can say that the market flows show scalability and self-similarity. In the solid low before 1 and in number 1 itself, we have an important level marked by the black horizontal line. This line shows the level where the buyers were supposed to not let the sellers pass, and we mark it on the chart because buyers did let the sellers pass a little, but as we can see in the lower tail of the hybrid bar in number 1. At high number 2, we can see that price begins to form a frequency in those upper tails, and after the creation of a hybrid bar down, buyers pass the control to sellers to do their thing. As I often say, price action is an endless swinging motion between buyers and sellers, where one player accumulates energy while the other player spends it. That of course relates to the simple and elegant physics related to the markets. Notice that unlike the price factor from number 1 to number 2, the vector from number 2 to number 3 descends in a running flow instead of a standing flow, and it goes back right to the black line that marks the moment where buyers almost let the sellers assume the control of the market. We can even draw a pitchfork using 1 and 2 as the B and C axis respectively to see how the end of this down vector correlates with the black line in the center line of the fork. That would be a great idea for a long trade, by the way, because we have the intersection of several contextual and technical elements. We have price coming back near low number 1, which is itself a solid low after price made the high number 2, meaning that 1 is a place where buyers are likely to appear again. Up to that point in time, the bias of this market was to the upside because it was making higher highs and higher lows. There was no market extreme failure of any kind to twist this notion of uptrend. Beyond that, we have price coming back down to the horizontal black line we already discussed and to the center line of the previously drawn pitchfork. As you can see, there is a correlation or an intersection of contextual and technical elements in this area that enables us to extract a narrative out of price action. It's important to notice also that we have a solid place to put a stop loss order a few pips below the solid low number 1. This is the hallmark of a great trade opportunity, the confluence of contextual and technical elements to form a narrative, a good and logical place to put a small stop loss order, and enough headroom to place a large take profit target in order to create a high expectancy value in terms of risk management. The iteration of these trade qualities is what is going to produce the ultimate goal of a trader, which is not performance, but unbreakable consistency. Look at what happens to this long trade idea. Even though it has all the necessary qualities and it does actually travel into profit territory, it ends up failing. When price reaches point number 4, buyers start to lose force. Intelligent risk management would have made you collapse the risk for the long trade idea at the moment because the profit would be a few times larger than the original risk, so we can safely assume that in this situation. The fact is that buyers had all the tools to drive the market higher than point number 2, and yet if they failed to do so. Price ends up coming back once again to the reliable horizontal black line that has been the axis of this analysis the whole time. This not so obvious fact is what should make you change the bias to the downside for a very simple and logical reason. If buyers had all the necessary requirements to advance price in their direction, and yet they completely fail to do so, it means that they don't have enough power to confront the sellers of the market. The talent of a price analyst is to anticipate a market player's power from these subtle clues. As you can see, it's not just a matter of observing what market players do, but it is also a matter of observing what they don't do or what they fail to achieve. That's powerful information as well. This is the moment where the advanced technical aspect comes into play. In number 5, some people might assume that buyers will attempt to initiate a movement that will attempt to go higher than 2, as it did in number 3. But number 5 is nothing more than a moment where buyers will lift the ball for sellers to kick it out of the park. It's a chance to go short, not a chance to go long for all the reasons we have been discussing so far. This is where we start looking for the technical lines to help us identify the precise moment where sellers will start attacking the market in any significant degree. There are 3 elements to this. 2 of them are rather obvious and 1 is more refined. In high number 4, we have a frequency line that is not an inward frequency, but it is a frequency nonetheless. And we have the obvious modified shift pitchfork using points 2, 3, and 4 as its axes. The third element is a blue pitchfork that has the same B and C axis as the red modified pitchfork, but its A-axis is grounded on an abstract position derived from a technique called negative vector extrapolation. We can eliminate the possibility of an arbitrary negative vector extrapolation by checking its validity, as we can see frequency along the center line of the blue fork. Finally, in number 5, we can observe a gentle frequency shift in the lower line of the blue pitchfork, and we use that to make a Newtonian extrapolation to the center line. This complex combination of the black frequency line, the red modified shift pitchfork, and a Newtonian extrapolated lower line from the negative vector derived pitchfork creates a perfect triple intersection in point 6. The final nail in the coffin here is the appearance of a hybrid bar precisely in this point, where the 3 lines intersect beautifully. Let's see how price behaves from this point onwards. As you can see here, the quadruple intersection with 3 lines and 1 hybrid bar was the birthplace of a large downward movement of roughly 1,000 pips. If we extend the red modified shift pitchfork, we can even see how well the projection pinpoints the end of the downward movement almost exactly. Hopefully you were able to perceive that making 1,000 pips in the euro-dollar is not so easy, but it is in fact possible with the correct type of analysis and the correct type of tools. I developed several price action courses dedicated to illustrate and explore all of these techniques I showed in the video and much more in great detail. If you want to learn more about the professional way of analyzing price action, check out the courses in the link available in the video description. If you wish to support the continuous creation of this type of video, don't forget to click the like button, subscribe to the channel, activate the notifications button, share the video with your trading community, and leave your feedback below in the comment section. Thank you very much for watching, and I hope to see you in the next videos. Take care.